Alright, so all we're hearing is bad news. Bad news out there in the stock market with the risk of a recession, interest rates are going up, and Papa Pal's like, about to suck the money out of the economy a la Luigi's Mansion style with his quantitative easing. Inflation is still at a record high, and the stock market had one of the worst starts to the year pretty much ever. In fact, true story, the week before last when the stock market went up, the Dow Jones, which is one of the indexes for the stock market, was down 8 weeks in a row. And that makes it the longest streak of losses since the year 1932. So if you stayed invested in the stock market, congratulations, you survived another once-in-a-millennial lifetime event. Also, real estate is finally starting to slow down, with new home sales last month going down to the lowest levels that they've been since last April. Crypto has also lost over $1 trillion off its market cap this year, and NFTs have essentially become worthless. Joke's on me though, because I own a lot of those. So today I want to take it into a little bit more of a positive direction and show you how I'm investing in this crazy market specifically for passive income. Now, just a heads up, there are far smarter, better people talking about this stuff on YouTube than me, but when I started my YouTube channel in 2019, I showed you my portfolio, which at the time was worth roughly $200,000. And I love making those video updates, not to show off, but to keep myself accountable and show you how I'm investing. So I'm excited to show you exactly that, because sometimes when the world's on fire, it's nice to know that we're all in it together. So as promised, here is my stock portfolio today. It's worth roughly $562,000, but it fluctuates a couple $1,000s every single day. And some of this growth has come from the crazy growth of 2020 and 2021, where we grew 28.6%, but some of that has also come from getting these dividends and reinvesting them back into the portfolio itself. So let me show you this. This is so cool, because in January, my dividends paid me $578.10. Now, that's not a ton of money, but that's enough to pay for all of my monthly food expenses and then some. But more importantly, it represents an 11% increase over what I earned last year in January. So I've been keeping track of this stuff since as early as 2015, and it's been super helpful. Then in February, I earned $831.40. That's a 25% increase over last year's February. I mean, these are massive numbers. Then in March, I earned $1,509. That's an increase of 48.6%. And the most amazing part about that is that it's almost enough to pay for gas these days. Usually, it's the end of each quarter that pays the biggest paychecks, so watch out for those. Then in April, I earned $575, which is a 10% increase over last year's April. And in May, I earned $835, which is an increase of 7.5%. Now, besides the fact that I get paid to sleep while I earn these dividends, here's why this strategy is so important right now. After accounting for taxes, inflation, and fees, if you had invested $10,000 in 1961, by 1981, that $10,000 would be worth only $6,600. Could you imagine investing for 20 years of your life only to look back at your initial investment and see that it lost value? Most people would probably quit. But if you had stuck with it from 1979 to 1999, that same $10,000 would be worth $48,000, which proves that sometimes when the market goes sideways, which can last for years in some cases, or especially when it's going down like it is this year, it's an amazing feeling to have this passive income in the form of dividends, because not only can I use this money to pay for my day-to-day lifestyle if I wanted to, but more importantly, I can reinvest the money back into the market and lower my cost basis, or the price at which I'm buying my stocks. So once again, it proves that the snowball effect of compound interest, that Warren Buffett is right once again. So with that said, let me just show you how I've set up my account to generate this sort of passive income with almost no effort on my part. This is the one strategy that's been proven to succeed regardless of what's happening in the market, which is to stay invested and to dollar cost average. So with that said, let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the magic. I've been practicing this coin trick right here. It's an analogy for the stock market. Invest, they said. Watch your money grow, they said. So last week, the stock market was finally nice to us and the S&P 500 went up 6%. So let me explain exactly how that happened, because sometimes stocks go up and sometimes they go down, you see? Thank you, no autographs. You can buy my stock course down below. Just kidding. I'm not selling you any courses, but here's some information you can actually use to understand market psychology. First, investors like to look at middle-class America and our shopping habits, and based on how we shop, people like to make predictions in the stock market. The week before last, for example, retail giants like Target and Walmart reported on their earnings and they weren't good. So investors looked at that information and thought, wait a minute, if those guys are struggling, that means the economy is going to do really bad. I better sell my stocks before things get worse. So they do, and the market goes down. But then last week, several other companies in the retail space reported their earnings and they weren't so bad. Costco, for example, which is obviously another place America shops at, matched their expected earnings per share, or the EPS, which was $3.04, which is exactly what they ended up doing. And they beat their earnings expectation in Q1 by about $1.3 billion, which is good. Another bit of good news is that Macy's beat their expectations, which was 82 cents a share, and they made $1.08 per share, which is a 32% increase over what they were expected to make. Nordstrom also reported above average expectations, which tells us at the very least that the higher income earners are also spending money. And then there's the Dollar Tree store, which increased its EPS by 48.1%, which is pretty insane. So when investors look at these earnings, specifically from places where the middle class shops at, it tells them to be a little more optimistic about the economy's future, because at the very least we know that people are out there and they're spending money, and that's a good thing. Now, personally, I don't make my investing decisions based on day-to-day or month-to-month fluctuations like this, because to me, that's gambling, and that's exactly how people lose money. Instead, I try to make my life as automagic and as simple as possible so I can set everything up without having to worry about it. So let me share with you exactly how to do that. But first, a quick word from today's sponsor, because I gotta pay my bills too. One of the most commonly asked questions I get is, Andre, if you had $10,000 to invest right now, how would you do it? And that's a trick question, because I don't know. No one knows. That's why people are sitting on more cash than they ever have in the last 20 years, according to clients surveyed by Bank of America. And with every major index headed into bear territory and crypto losing $1 trillion off its market cap, the Wall Street Journal says that the options are shrinking. But here's one possibility to consider, because get this, Bloomberg recently asked this same question to financial experts, and they overwhelmingly recommended investing into alternative assets. For example, this Andy Warhol painting was purchased for $5,000 in 1967, but just last week, it was resold for $195 million, which is insane. Just for context, that kind of price appreciation averaged out translates to $10,000 every single day over the last 55 years. Contemporary art prices have outpaced the S&P 500 by 164% over the last 25 years. And that's while sharing a very low correlation to the stock market. So this got me really interested, and I reached out to the only platform I trust investing in art, which is Masterworks. Not exaggerating, they just shared with me a CSV file of how much our community has invested, and so far we have put in over $1.3 million investing on their platform in paintings by legends like Banksy, Basquiat, and Picasso. Crazier still is that since launching, the 3 paintings they've sold so far have returned a net annualized gain of 30% to their investors. And even though I have to add that past performance is no guarantee of future results, the numbers are still pretty mind-blowing, and it's no wonder they've been valued over $1 billion. The demand is high, and there is a waitlist, but my partnership with Masterworks allows my viewers to have priority access to skip the waitlist, so click the link in the description below the video. Now let's get back to it. So here's my Robinhood app right here. This works with any brokerage. It doesn't have to be Robinhood. Use whatever you'd like. So the first thing that I do is I click on the bottom right-hand corner where the little person icon is, and if you scroll down to investing, the first thing that I focused on creating was what's called a recurring investment. And this is where you can buy a specific stock automatically on a specific schedule. Now, the stock that I chose is VTI. This represents the entire US stock market, and by buying this one stock, I'm instantly diversified with several thousand companies, so I don't have to worry about picking individual stocks. So I really like that. Now, it also shows me that I've invested $154,000 so far at a rate of $1,000 a day. which I realize is not a relatable number at all, so don't focus on the number I'm investing. It will work as long as you are consistent with a lot less money. So if you want to focus more on passive income, that would be stocks like SPHD, which I own, as well as VYM. These ETFs are also a compilation of a bunch of stocks that focus on paying a higher dividend yield than VTI. So again, those are also great stocks, and they focus more on that passive income that I showed you earlier in the video. You can't go wrong with any of these. It just depends on the kind of strategy you like. So I can't stress enough exactly how fast you should set up this recurring investment, and I wish I did this sooner, but here is why I really love this strategy. Check this out. If I click on that recurring buy, it gives me a breakdown. Like for example, it shows that my first order was placed on October 18th, 2021, which is when the stock market was doing good. But instead of chasing the market like most people did, I have money still to buy the dip of the dippity dip because I have this recurring investment going on. So here's what I love about this, because it shows me that the average cost was $224.91, but the current price is $208.85. So yes, I'm down, but 15 years from now, that's not gonna matter because my cost basis will be lower than the price will be in 15 years from now. Whereas if I had invested all of my money rather than doing this strategy, I might be tempted to sell everything right now so as not to lose more money, which is exactly how people lose money in the stock market. Now, the second thing I do is this. I click on the little person icon once again, I scroll down a bit to the Edit Dividend Reinvestment, so I click on that, and this is called DRIP, the Dividend Reinvestment Plan. And this allows you to automatically toggle each of the stocks that you own and turn on or off the ability for you to reinvest automatically that same money that paid you, that same company, back into that same company. So you could do this for each of those individual stocks, or you can do this all at once and you just toggle it on and off, and that's it. Now, for me, I just reinvest everything back and I just keep it at that. But remember, DRIP, the dividend reinvestment plan, still means you have to pay taxes. Just because you're reinvesting your money does not mean you don't have to pay taxes. You still do, but you are taxed a little bit more favorably, but that's a separate video. So with those two things set up, I will beat 90% of professional experts without being a genius, without having to do any math, and without lifting a finger. The only thing I need with this strategy is not money, it's just time. Now, I've been keeping track of my income since as early as 2015. So it's kind of crazy to look back at January 2015 and see how much my numbers have changed. So if you want to keep track of your income as well, I'll leave the link down below, but it just goes to show you, you don't have to be a genius. You don't have to try to time the market. You just have to find a strategy that works for you and stick with it. But people don't because they get bored, and that's how they lose money. So don't get bored. Make money instead. Now, if you've made it this far into the video, I just want to share with you one little warning about what's going on in the market right now. Earlier in May, I made a prediction video about what would happen to the stock market based on data that I found from the past. And it's so far kind of coming true because in the video I said that 2 weeks before interest rates went up, the market would go down. 2 weeks after, the market would also come back down. But then it would start to recover until hopefully by about the 6-month mark, it would recover big time. So we have yet to see about that. But I also said if you're going to invest a little heavier, it might be a good time to do so between May 4th and May 18th, and that turned out to be true because right now you would actually be up. So history is repeating itself in the sense that market psychology is finally getting used to these interest rate increases, and because so much of these negative news have already been priced into the market. Add to the fact that Papa Powell has laid out the path for interest rate increases at 0.5%, and Mr. Market is happy because anytime Mr. Market can predict what's going to happen, it is happy. So that's a good thing. Now here's the reminder that I wanted to put out there because it's about those relief rallies we talked about. These usually happen when the market falls 20% or more, which we've had in some indexes already, and then the market starts to recover. So what we could actually be seeing is not a recovery, but a false rally. And these happen after the market again falls 20% or more, it comes back up, it lasts for around 2 months on average, and then the market falls again. And it tricks investors into investing more money because they think we're seeing the beginning of a recovery. And it's another reason why I try not to invest based on timing the market, because no matter how much I think I understand, and no matter how much I reference historical data, no one really knows. It's only useful to understand the market in hindsight, but we can never predict what's gonna happen. That's why the only strategy that is known to work time and time again is to dollar cost average and put money in consistently regardless of what's happening in the markets. This is something that I've been doing for a really long time, and it's something that I hope you'll start doing as well. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Go grab up to $250 worth of free Bitcoin right here. Grab your free stocks, links are down below, and then go track them automatically with a spreadsheet linked down below in my Patreon. Love you. Thank you so much for watching this video. I'll see you back here on Monday and Friday, sometimes a Wednesday. Bye-bye.